Hi everyone, I'm Ken from Crypto Trading KS. A couple of issues that you want to keep your eye on. Coming up in the next day or so, the core PPI year on year and month on month is coming out in around 7 hours, and about 12.5 hours the FOMC Minutes. And then in about a day, the CPI, the inflation rate. That is going to be a very important day. If we start to see yields go up and the DXY go up, that will give us an indication that smart money expects the Fed to tighten. That is, raise the federal funds rate. You can find economic data releases on ctksnews.com under Market Analysis. Let's have a look what the main markets did in the past trading session. Broad-based, there were gains. What about the crypto market? Broad-based, it's not looking too crash hot at the moment. However, there are always opportunities inside every single market, and if you go to ctksnews.com across to market cap, you can see crypto bubbles right up the top of the screen. WAXP and REC are doing very well. If you scroll down a little, we can see that Bitcoin and Ethereum are both down. When Bitcoin comes down, the rest of the alts kind of just follow suit, except for the inverters, and the inverters like WAXP and Request Networks and even Beta. We can see Unfi, Protocol DAO is just down here and it's doing quite well as well. To get an idea if the particular price momentum is sustainable, it's good to change timeframes and just get an overall picture of where price action is going. We know that the core PPI and the PPI is coming out soon, as well as the FOMC Minutes. This can really move the markets around, so it's important to be aware of these economic events. When we look at the S&P 500, economic events move things around, but within structure. That is, objective dynamic market structure. When we check out the S&P 500, what we notice is the S&P 500 is just marginally above a smart money support level at 43.56. The bears would see the market lose that level and lose the next structural level at 43.50 to make its way down to the 43.25 level. This is the bear case for the market. That's what the bears would be hoping for. However, if we don't lose the 43.56 level, the bullish case is to use that as support and rebound up to a much stronger structural resistance level at 43.72. That's a fairly substantial one. It's not going to be that easy for price to break through, and we've seen previously it come up, the S&P 500 come up and just get stopped out by that level. It's come down to a support level. If we do manage to get above the 43.72 structural resistance level, the bears will be looking to exert negative price momentum around that 43.84 level to coincide with what happened previously. The next target for the bulls will be that 44.03 level. You can get this structural indicator from ctksmethod.org. When we look at gold's price, it's important to know where is the actual structure inside this price history, and gold started trading at 1833. To answer that question, we throw on the gold indicator. When Hamas invaded Israel, we had a spike up with gold, but this structural level caused gold's price to slow down. At that 1851 and 94 cent level, we saw gold come up and challenge structural resistance again at 1857 and 82. It didn't manage to hold on to it for long, but it found structural support again, and it's been challenging that higher level at 1857. It's currently over, and there is a bullish case for gold to head towards that 1872 level. If the bears take control, they'll seek to push it down below 1857 and again below 1851, right down to a target area of 1841. If yields continue to push higher, especially the 2 and the 10-year yield, the good thing to note is there's structural resistance at that 5.0079 area and just up a little higher at the 89 area. The bulls would be expecting to breach these levels and then attack these upper structural levels up here from approximately that 5.0316 level and upwards. If the bears take over the yields, and that means that inflation is getting under control, the PPI has come in lower than anticipated. We could see yields collapsing all the way down to the next structural buy area at 492.05. The Federal Reserve has come out and said it's unlikely they will push rates higher for longer. But of course, Fed speak is Fed speak. It's always two-edged. But the concept is the markets have pushed yields down and the DXY down as well. If we get continued bearish momentum on the DXY, we would expect it to come down to the structural level at 105.6357. There is also stronger structural support at 105.59. When looking at structural levels, they're literally like safety nets. If the buying is so strong, it won't even get down here. And we've seen that in the past, just recently. This may mean that the DXY could actually turn around and become bullish. The market is almost pricing in the fact that the DXY and yields could be coming up because the PPI could be hotter than anticipated. For the bullish case for the DXY, we would expect it hitting the structural resistance level at 106.08. If the yields come up and the DXY comes up and we get a bullish case on both of those, expect the stock market and Bitcoin to come down. If we see a bearish case and the DXY and the yields start to break down, expect bullish momentum inside the stock market and crypto. Crypto is an incredibly risk-sensitive market. It's pricing in that the PPI will come in hotter than anticipated, and we see this playing out on the major alts. Bitcoin, Ethereum, Binance Coin, XRP, ADA, Doge, Solana, and Tron, they're all registering negative price momentum. It's vitally important to understand where structural resistance and structural support are inside price market structure. When you're looking at a chart, you can have recent indicative price draw out support and resistance lines, but these are not structural lines. How do you get structural lines? You actually use the CTKS method, and it's embodied in this indicator. What you can see, the structural resistance lines above Bitcoin's price. And when we think about it, this kind of price action is not very good. We had a structural support line playing out at 27,357. This particular line held price quite well. We saw it weakening, but it didn't come down to the next structural buy area. But it did recover. But this particular price action, and you can see the US 2-year yield is starting to spike. It's starting to rally. These are alerts that I give to the CTKS method monthly service members. What you can see is the breakage of resistance, support, support, support. This is not good. We've got a lot of overhead resistance now that was once support. That puts in favor the falling continued bearish momentum inside Bitcoin and crypto at least to the 26,918 mark. Just a little bit lower at 26,907, and there's another structural support line at 26,892. All the charts are intercorrelated and interconnected. Sometimes you can get bearish momentum. The price structure finds support and then rebounds. In this case, we'll be keeping our eye on these structural levels up above, 27,236, 27,290, as well as that 27,358. So it's important to bear in mind that we could get a retracement and also a bounce. Price is always moving in a wave. There's a bearish case and a bullish case. When you look at the stacking of probabilities, if the yields start to spike, we would go in favor of the bearish case. That's what we would be looking at. And if you want to see lower or higher structural support or resistance levels, they are available inside the service at ctksmethod.org. Right now, we're seeing bearish momentum inside the crypto market, but we're coming up in terms of total crypto market cap to a lot of different structural support levels. We can see these structural supports here, here, and down here. They act as a safety net to catch price and rebound it, trampoline it in the other direction. And what we'd anticipate, if price reverses here, the next resistance level will be up at 1,051 trillion. It's important to keep in mind Bitcoin and total crypto market cap. They hang out together, they're best friends, and they influence each other wildly. When assessing structural support and resistance levels, it's very important to look firstly across the Tier 1 charts. They'll give you an incredible insight into where price could be going next. The Tier 2 and the Tier 3 act as your methodology of stacking probabilities. If you would like the indicator that I use each and every day on my charts, it's available through ctksmethod.org. The PPI helps us to understand inflation from the producer side, so they're going to be very important statistics for the Fed to look at. The FOMC Minutes, not so much the minutes, but just what they talk about after that inside the press conference, will dictate or give the street some sort of understanding as to where they're going next. So far, we have the concept that the Fed will be easing off rates. It's seen yields absolutely spiking, and it needs to slow it down. But you can see the CPI, the inflation rate, core inflation rate, initial jobless claims, just in 24 hours, just in the next day. The markets you can expect to be pretty volatile. With the yields coming up, we've already gained some sort of insight, and Bitcoin going down, that yields will again rise and the DXY will too. So please bear this in mind. It's also vitally important to understand that there are always opportunities inside every market. Just because some, or mainly all, particular market participants go down doesn't mean that all of them go down. As you can see, you can get a concentration of value in just a couple of names, and if you pick correctly, you can do incredibly well. Thanks so much for sharing this time together. I'm very grateful for you being here. Wishing you a fantastic day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.